Ever wondered why your bank balance sometimes feels like a distant cousin to the profit and loss statement your accountant keeps showing you? Can be a head-scratcher, right? You're seeing cash come in and out, but your business's financial health, according to those reports, tells a slightly different story. Well, you've stumbled upon a fundamental concept in accounting that explains this very phenomenon, the difference between cash and accrual accounting. And if you're using QuickBooks, understanding how it handles these two methods is absolutely crucial for getting a clear and accurate picture of your business's financial performance. Think about it. Let's say you're a web designer. In December, you complete a massive website project for a client, sending them an invoice for a cool $10,000. They love it. High five all around. But here's the catch. They don't actually pay you until January. Now, when did you earn that $10,000? Was it in December when you poured in the hours and delivered the service, or in January when the money finally landed in your bank account? This simple scenario lies at the heart of the accrual versus cash accounting debate. And QuickBooks, being the powerful tool it is, gives you the flexibility to choose which method best suits your business needs. So, let's dive into the cash method first. Imagine your business as a piggy bank. Money in, it's recorded as revenue. Money out, it's an expense. Simple as that. Under the cash method, transactions are recognized only when the actual exchange of cash takes place. In our web design example, the $10,000 would only show up as revenue in January, the month you received the payment. Similarly, if you paid for your web hosting in November, that expense would be recorded in November, regardless of when the actual service was used. The beauty of the cash method lies in its simplicity. It's straightforward, easy to understand, and provides a clear view of your immediate cash flow. This can be particularly useful for very small businesses or sole proprietors who primarily focus on tracking the money coming in and going out. It aligns well with your bank statements and can make managing day-to-day finances feel more intuitive. However, the simplicity of the cash method can also be its drawback. It doesn't always provide a true picture of your business's profitability at a specific point in time. Consider our web design example again. By only recording the revenue in January, your December financials wouldn't reflect the significant work you completed that month. This can distort your understanding of your business's performance and make it harder to make informed decisions, especially when it comes to long-term planning or securing financing. Now, let's shift gears and explore the accrual method. Think of this as a more comprehensive way of tracking your business's financial activity. Under the accrual method, revenues and expenses are recognized when they are earned or incurred, regardless of when the cash one actually changes hands. 2. So, going back to our web design project, under the accrual method, you would recognize that $10,000 in revenue in December, the month you completed the work and earned the income, even though you didn't receive the payment until January. Conversely, if you received an invoice for software in December but paid it in January, the expense would be recorded in December, the month you incurred the obligation. This matching principle, recognizing revenues when earned and expenses when incurred, provides a more accurate and holistic view of your business's financial performance over a specific period. It paints a clearer picture of profitability, regardless of the timing of cash flows. This is why the accrual method is generally preferred for larger businesses, those seeking external funding, or those that carry inventory. It adheres to generally accepted accounting principles, GAAP, providing a standardized and reliable framework for financial reporting. So, how does QuickBooks handle these two methods? Thankfully, it offers you the flexibility to choose either cash or accrual accounting. When you set up your company file in QuickBooks, you'll be asked to select your accounting method. This choice will then dictate how QuickBooks records and reports your transactions. If you choose the cash method, QuickBooks will primarily focus on the dates of your payments received and payments made. Your income and expense reports will reflect transactions based on these cash flow events. If you opt for the accrual method, QuickBooks will focus on the dates of your invoices and bills. It will track when you earned revenue, when you issue an invoice or complete a service, and when you incurred expenses, when you receive a bill or use a service, regardless of when the money actually moves. QuickBooks achieves this through its features like accounts receivable and accounts payable. When you create an invoice in QuickBooks, it increases your accounts receivable, recognizing the revenue even if you haven't been paid yet. When you enter a bill from a supplier, it increases your accounts payable, recognizing the expense even if you haven't paid it yet. These balances are then adjusted when payments are received or made. It's important to note that while you set a primary accounting method for your company file, QuickBooks often allows you to generate reports on either a cash or accrual basis. This can be incredibly useful for gaining different perspectives on your financial data. For example, even if you primarily use the accrual method for your official reporting, you might run a cash flow statement to get a clearer picture of your immediate cash inflows and outflows. Choosing between the cash and accrual methods depends on various factors, including the size and complexity of your business, your reporting needs, and even tax regulations in your jurisdiction. For many small businesses, the cash method might seem simpler and sufficient. However, as your business grows and your transactions become more complex, the accrual method often provides a more accurate and insightful view of your financial health. Ultimately, understanding the difference between cash and accrual accounting and how QuickBooks handles them empowers you to interpret your financial reports more effectively and make more informed decisions for your business. It bridges that gap between your bank balance and those seemingly abstract financial statements, giving you a clearer understanding of your true profitability and financial position. With that said, thanks for watching, and until next time.